Welcome to the weekly video update, where I'll go over the action in the market for the week of November 6th through the 10th, and then we'll see how things look for the week of November 13th through the 17th. We ended up having an up day for the S&P. Monday, Tuesday, and Wednesday were pretty comatose. We didn't see an awful lot of movement. On Thursday, we had a down day. On Friday, we came back with an up day. The one thing to make note of is that we were below average with volume each day of the week, and that puts us under the average for the entire week. So you're seeing not an awful lot of conviction right now as folks are nervous about what's going on geopolitically, but at the same time, they're going with the idea that the stock market is still fairly healthy and could go higher from here. We're coming into some positive seasonality, but they just want to be careful at the same time. Before I get started, please note that in every video that I post, there is a PDF in the description below each video of these slides that you're looking at, as well as all of the charts that I use. Sometimes people find this helpful to download those and kind of follow along, especially if whatever you're watching the video on doesn't give you a real good, clear picture. You might try the PDF to see if that's more helpful. Also, every day I post what are called pivot points. These are pre-calculated support and resistance levels. Some of them apply for the whole month. Some of them only apply to the next day. I post these on the community tab on the YouTube channel. I'm not able to do that on Rumble. So if those are of interest to you, please feel free to check that out. I do have a private Facebook group. So far, I'm still the only one really posting anything there. So there's not an awful lot of popularity to that. But if you want to come and be involved in that and maybe have some back and forth, you're more than welcome to do that. I will be posting a new poll. I'll go through the results of the latest poll here in just a few minutes. I do really keep an eye on YouTube comments as well as Rumble comments. I'm trying to keep the garbage comments and the bot comments. I get rid of those just as fast as possible. As soon as I see them, they're gone. But if you want to say something or interject some kind of an opinion, even if you don't agree with a conclusion that I've reached or something that I've said, or if you have a suggestion, please feel free to offer that. I'm more than open to that. If you don't want to do that in a public type setting where you actually post a comment, I do provide an email address at the end of this video, and you can contact me in a more private manner if that pleases you. I do post the videos on Rumble as well. Here's a link to the channel. It's also in the description. A week or so ago, I was having problems uploading to Rumble, but there are also times when I have trouble uploading to YouTube. It just depends on the time of day and what's happening at any given time. If you can't find me on one platform and you're comfortable going to the other platform, see if you can find the video that way. And I try to post these in as timely a manner as possible. All right, let's go back and talk about what happened in the week. So for the week, we were up 1.31%, and pretty much all of that was in Friday's session. We were below average with volume. You've got a lot of apprehension out there right now. The technicals were switching back a little more positive on the weekly charts. There's some positive things. There's some negative things. We're always going to see that. You'll never see things completely black and white when it comes to the stock market. Whether you're looking at daily charts, weekly charts, or what have you, there's always something to be aware of that can justify either a positive stance or a negative stance. Inflation and interest rates are really what the market's focused on, as well as growth concerns for the economy, as well as individual companies. We also have a lot of geopolitical concerns right now, specifically with what's going on in Israel. And then we're still in earnings season. We're kind of beyond the big bulk of earnings for the S&P 500, but there's always earnings that are coming out, and that can be influential for the market. And then we did have some Fed speak this past week that I'll go through in just a moment. Our trend is still weakening overall. We have the ADX going below the moving average, and it's dropping below 20. And the green line is now dropped below the red line. That's on the weekly chart. We've switched back more over to positive on the daily charts. So for the week, the Dow was up 0.7%. The NASDAQ was up 2.4%. The S&P was up 1.3%. But the small caps, as denoted here by the Russell 2000, were down 3.1%. And that's a real area of weakness and a concern right now for the market. So just to go over some high points here, mega cap stocks for the week were pretty strong. Even on the days when we really didn't go anywhere, they held up fairly well, where the broader market ended up being weaker. Monday, Tuesday, and Wednesday were really boring. My goodness, if you watch things as the markets open, it's like, okay, I would rather be doing anything else than watching what's not happening here. The S&P did end up closing below 4,400 on Friday, and that was just captured on Friday. Small and mid-cap stocks were down for the week, and this is an area of concern. In a healthy environment, we want to see both of these stocks, small and mid-caps, doing well in this kind of an environment, and that's just not happening right now. Then what happened on Thursday was there was a weak treasury auction. They had some auctions earlier in the week that seemed to go well. Well, then there was one on Thursday for the 30-year bond, and there wasn't a lot of demand for that. And that kind of spooked the markets. It spooked the bond market, which ended up spooking the stock market. And then also Chair Powell came out with some comments. He pretty much had stated what he had said before, but it was taken as positive when he said it the first time. On Thursday, it was taken more as negative. And basically his big quote was saying, if it becomes appropriate to tighten policy further, we will not hesitate to do so. The market's been on watch for that already. We're watching the economic reports as they're coming out. They're tending to be a little bit weaker than expected overall. And as I've been saying in the daily videos, right now, bad news is good news when it comes to economic reports. But if we go too far in the other direction, pretty soon bad news is going to become bad news, and the market's going to get concerned about that. Interest rates were up, and also the dollar was up on the week. We're keeping an eye on the VIX, and I go through this in every daily video, where possibly we're coming into this period now where the VIX tends to go down. It goes in the opposite direction of stocks. We're also keeping an eye on inflation, and this chart hasn't been updated in a while here. I'm trying to give a bigger picture look, where if we compare 1966 to 1982, and then the gold line is what had been happening up until about the end of June in 2023, we're kind of going in the same basic direction with things. Well, we do see inflation starting to fall off, but then after that is when we really start to go up. Now, is the market really concerned about that? Not necessarily. But based on the weak auction that we had on Thursday, I mean, do you want to tie up your money for 30 years and buy a bond if interest rates are going to be a lot higher a year or two down the road than they are right now? That can kind of speak for something right there. Then we're also keeping an eye on the 10-year yield. We ended up closing at 4.63% on Friday. That's above the 4.02%. Based on the RenMac research, when we're above that 4.02% level, that's when it starts biting into corporate profits and corporate earnings. Here's the poll where I posted this a week ago, so it's going to be kind of interesting to see this. When I wrote this a week ago, it said, from now until the end of 2023, do you feel that the S&P will hit an all-time high? 28% said yes, and 72% said no. By the way, I don't vote in any of these surveys. I try to come up with the questions, I post them, but I don't participate in them. I just want to see what you guys have to say about this. The next question, do you feel that economic reports that will be released this week, the week that just ended, will come in stronger or weaker than expected? Stronger, 42%, weaker, 25%, about in line was 33%. I think it kind of came in a little more on the weaker side of things. And then, do you feel the positive seasonality will continue in the upcoming week? We were going through kind of a choppy week seasonally, and that kind of put some pressure on things. We could be beyond that now. Now, nothing is ever going to stick to what's already happened in the past, but we can get some general guidelines by looking at seasonality, and I have a lot of charts to show you that later on, where it was split 50-50. Yes, we will. No, we won't. And then the last question was a week ago on November 3rd. The S&P was able to recapture its 200-day and 50-day simple moving averages. However, prices are just underneath a long-term trend line. Do you feel that this will act as resistance and turn down, or the prices will be able to break through to the other side? That's a pun on the Doors song. It was 77% said that it will act as resistance, and that would be true up until Friday's session. We ended up closing just a little above that after Friday, and that prices will be able to break through the trend line. 23% said yes to that. Okay, just a couple of charts from Isabel Net. This is just looking at earnings going out into the future, both from Morgan Stanley and then the consensus. The thing to really note here is that we're seeing an upward bias to these projections going out, and that justifies higher stock prices. Then FactSet had a number of blog posts, well, 2 blog posts, but a number of charts. The one that was posted on Friday said analysts expect the S&P 500 earnings growth to improve in the first half of 2024. And that's this area. I put the red box around this. And so they're predicting that things are going to even improve from here. That could also justify higher prices. Then the other post that they made, S&P 500 companies, they see the largest negative price reaction to negative earnings per share surprises since 2011. And then I'm just going to read through kind of the important parts of what they said. At the time they posted this, and this was Tuesday, November 7th, 81% of the S&P 500 companies had reported, 82% had earnings above estimates, and then in aggregate, they exceeded by 7.1%. I don't go into the 5-year and 10-year too much. So given this strong performance relative to the averages, how has the market responded to the earnings surprises reported? That's what we're kind of wondering right now. We had a good response last week. We were pretty much comatose this week until later on in the week. Here's a chart where this is a positive surprise. After a company comes out with their earnings, and do they go up? If their earnings report is considered positive, what really happens is if they don't meet expectations, or even if they do beat expectations, a lot of times we see the old buy the rumor, sell the news. You pump up the stock, and then the earnings come out, and it's really good, and then it just sells off. That's people getting rid of it. But we're still seeing a real negative bias after earnings are coming out, much more in favor of any positive bias. And then this is just showing over a period of time that they're expecting the earnings to continue to go up and show some improvement. And then here, this is just projecting out. What do they think earnings will be? Where we're actually seeing a bit of a decrease when you take a 5-year rate of change on this. Then looking at our different charts, here's an intraday chart where we started on Monday, and not really much happened. Tuesday, not all that much happened. Wednesday, not all that much happened. And then Thursday was the day that we saw the big downward move. Right when you see this big downward movement here, this candle, that's about the time that the auction results were announced and Chairperson Powell started giving a speech, and the market just decided to go lower. Then we gapped up in Friday's session. We fell back a little bit and then spent the rest of the day going higher. And that was really where the strength came from. So for the week, and this is just the 5 trading days, we had the NASDAQ 100, NASDAQ, S&P, and Dow. We're all positive. We had the NYSE, which is a broader measure, the mid caps and the small caps. They ended up being negative. And then going back to the beginning of the year, we have the NASDAQ 100, NASDAQ, and S&P doing the best. Way over on the right-hand side, small caps are now down for 2023. Going back to the all-time high, all of the indexes continue to be down, with the small caps being down the most. Looking at different sectors, we were up, so this is the way I sorted this. You had tech, communication. Those have been 2 stronger areas. Then you had discretionary. That's been a stronger area, but then it kind of turned weak, and now maybe it's making a little bit of a comeback now. Where the areas that had kind of been in favor lately, especially energy, it just got hammered this past week. Real estate continues to be quite weak, and healthcare. And these are more of the growth areas or defensive type areas of the market. Looking at the relative rotation graph, please go back to your geometry class where we have the x-axis, that's the flat line. The line going up and down is the y-axis. When we're on this side of the y-axis, that's a plus, and we're on the plus side of the x, so that would be a plus plus. And the area that's doing the best when we go back a year continues to be energy, even though it's been falling off. We're seeing communication doing a little bit better, and tech is starting to show a little bit of an improvement, where we see the XLY, which is discretionary. That's been showing some weakness, and that's been a bit of a concern. Other areas are showing a little bit of an improvement. Then looking at the different sectors, this is just the 5 trading days that we've just finished here, where tech, communication, and industrials were up. All of the other sectors ended up being down, with energy and utilities being down the most. Going back to the beginning of the year, here's the 3 strongest areas: tech, communication, and discretionary. All of the other sectors are negative. Going back to the all-time high, energy is still in the lead, followed by tech and industrials. All of the other sectors are still underwater. Looking at sentiment, we did tick up a little bit. You've got a real fearful market right now because there are some big geopolitical things happening right now. With the update, we ticked up to 42. To give you some perspective, we had dropped down below 25, and that appears to be what could have been some kind of a bottom there. And as we've been coming up out of that, we've been seeing the fear and greed index also show some improvement, but not really all that big. Here's the active asset managers where they had become extreme negative. When it gets to that kind of a reading, we use it as a contrary indicator, even though these are professionals who trade stocks and manage portfolios for a living. They're still human beings. And when they get really extreme positive or negative, we look at doing the opposite. Here's another look at that same chart where we came in at 61.76. So there is some improvement here. And then looking at the VIX, where we were down on the line chart and we were down on the bar chart, we did see fear starting to go back up. But then as we recovered, especially on Friday, we saw this fear gauge really start to go down. The Ulcer Index is another fear gauge that we look at. When it gets higher, that means the stocks are really under pressure. This is actually dropping. It's actually dropped below the moving average on the daily chart. We look at the RIDEX bear bull ratio. When this is really spiking up, folks are negative on the market. When it's coming down, they're more positive. Please know that this is as of Thursday's close, that was the big down day. So you would expect this to really go up. But as with a lot of individual investors, they tend to react to what's already happened. And so they may have gone short or sold their long positions early on Friday, only to see us have a really strong up day. Then we look at the American Association of Individual Investors. A week ago was when this survey was done. We were really positive a week ago. So they're looking a bit more positive, but not necessarily extreme now. And then this compares the 1 to 3 month T-bills, which you could call cash, and it compares it to the tech sector. Now you kind of have to reverse this in your mind a little bit. When this black line's going down, that means the tech sector is going up. Well, back in 2022, the black line started to go up, and that means tech was under pressure. And if you followed the market a year ago, we were really having some difficulties. Well, then in 2023, we started to come back down again, and we really dropped off this past week. So this is suggesting that the tech sector is still strong, especially when you compare it to cash. Keeping an eye on the economy, here's the latest reading from GDP Now, where we're about 1 3/4% to the upside to a little bit negative on the downside for the forecast. Their estimate is the green line over here, where they have us up a little bit over 2%. Now we're focusing on the Q4 2023 over here, and that's the latest forecast. This tends to be quite generous as far as looking forward into things. So we may be looking positive here, but then when the real report comes out, it might be quite a bit less than that. Here's another look at GDP, where we have Goldman Sachs. They are the gray area right here, and then these diamonds are the consensus. And the thing that I would take note of here is that we're not seeing negative GDP looking out into the future. And that's one of the definitions of going into a recession, is that we have two quarters back to back of negative GDP. Well, that's not what they're forecasting right now. We look at the spread between risky bonds and not as risky bonds. If we were really running into trouble, this ratio would be going up. It's actually going down. And then we keep an eye on the Chicago National Financial Conditions Index. If we were running into problems, we would be going above the black line. We're actually declining below the black line. And then we finally had an update here. These are the tightening standards for banks. Are they getting really strict with loaning money out to people? It had been really going up, but now it's been starting to trail off. This was updated a week ago, the real-time SOM rule recession indicator. We only get nervous if we go above the red line, and we have not done that yet. Also, we get nervous with the U.S. recession probabilities, which is smoothed out. When it goes above the red line, that's when we get nervous. We're barely above the black line. Here's the Brave Butters Kelly leading index. We're coming down just a little bit. We were a little nervous about this one. It was starting to go up, but now it's beginning to come back down. Keeping an eye on inflation. This is inflation nowcasting, where every day they forecast where is inflation at. when you look at CPI, which is going to be coming out this week, and we also look at the PCE prices. That's another major inflation gauge that the market follows, and it just gives its projections. Some of these don't change at all. Some of them tend to change regularly. Keeping an eye on the Fed, there is still a 90.9% chance that when the Fed meets on December 13th, they are going to leave rates unchanged. They're currently at 5.25 to 5.5. That's what the market thinks they will be at. There's a 9.1% chance that they may go up. Now, this can change, and there's still some time before that meeting. If we get a lot of hot and heavy economic reports that come out, this could really change. But for right now, we're tending to see weaker than expected economic reports. And as long as that continues, we probably won't see a rate hike. This is showing how this has changed. The blue areas where we're at right now, then a day ago, a week ago, and a month ago, and we have kind of gone up a little bit to this idea that they will not increase rates. There is some participants out there that think we might go 25 basis points. There's even a few thinking we might go 0.5%, but this will always change and especially get more pertinent as we get closer to the next meeting. Here's the Fed balance sheet where it's continuing to drop off. It started to do that in June of 2022, and it's still continuing. This is looking at the year-over-year change where it's continuing to drop off as some of the bonds that they purchased they're maturing and they're not re-upping them, so they fall off their balance sheets, basically. Now, looking at our charts with the breadth, looking at price, we're above the moving average. We're still below the moving average based on volume, but we are showing some improvement here. Then looking at the new highs, new lows, we're seeing more new highs than we are new lows right now. And we saw that a week ago. So that's helping our 4-week moving average as well as our 10-week moving average to turn more positive. So that's showing more internal strength in the market. The advanced decline ratio, we see both the blue line and the red line above 0. That's positive. Accumulation distribution, we're seeing an improvement on the daily chart. We're also seeing this tick back up on the weekly chart, and we're just right about on the moving average. This tries to measure what the smart money is doing. Keeping an eye on our trend, the ADX is below 20, so this suggests longer term on weekly charts, we're not in a trending environment right now, and we're below the moving average, so it is a weakening moving average. The red line has been declining, but it's still on top, so we default to negative for the weekly chart. We're starting to default to the positive side on the daily chart, and we're still trending, even though it's also a weakening trend on the daily charts. Here is the Arun, where it really went negative. This thing just sleeps, and then all of a sudden, pow, it just comes to life. When we see the green line coming down and the red line going up, the green line are buyers, the red line are sellers, and the oscillator down on the bottom tries to measure the difference between the two. We had been positive, but with this past week, we really dropped off and are looking more negative. The mass index is not generating a signal right now. Some of our other charts, here's the daily chart where we just closed a little bit above this downward sloping trend line right here. You could say that we regained some resistance. We also were able to close above this long-term trend line here. So that is looking more positive, both on the daily charts as well as the weekly charts. We're above the midpoint with our trend channel going back to 2009. That's a little bit more positive bias. And we're coming back up to our pivot points here. We're wondering if we really start to scream to the upside, is this area going to act as resistance like it did last July? The 50-period simple moving average, we're above that, and the red line is going up. So this, after showing some weakness, is now starting to show some strength. Our long-term trend is also showing some improvement. We're above the blue line here. That's the 13-period or 13-week moving average. Looking at the McClellan oscillator, we had gone extreme positive and we're starting to drop back down. That's a little bit of a concern. We're turning more positive on the daily charts. And when we look at the summation index based on price, we're showing an improvement, but we're still below 0. We're just crossing above 0 based on volume. So longer term, this is looking more positive. We look at the Swenlin trading oscillator where we're dropping here, but we're still above 0 based on price and volume. We did drop a little bit below based on volume, where this has been turning down the last number of days, pretty much the last 4 or 5 trading days on the daily chart, but we're not seeing that reflected in price yet. Now, just to give you an idea, a week ago, This started to turn up on the daily charts a couple of days before we hit a bottom and started to go up. So sometimes we really want to pay attention to this indicator, but we don't want to put all of our faith in it at the same time, because sometimes it does give us false signals. Looking at the bullish percent index, we're showing an improvement on the daily chart and also here on the weekly chart. We did drop down below 30 and now we're coming back up. That's a pretty significant buy signal, and we're seeing that confirmed from the daily charts to the weekly charts. Here's the PMO. Momentum is still negative. We're still going down with the PMO. We're showing some improvement based on price and volume, but not an awful lot yet to turn things back up. Looking at the PMO studies, we're coming down after we were showing the PMOs that were rising. That was extreme positive. We're just starting to get extreme positive with the buy signals, but we are turning more positive with the PMOs that are above zero. The percent B indicator, the Bollinger Bands are up here on top. This measures when we close outside the upper or lower band. Right now, we're just about at the midpoint. This is a little bit positive because we're crossing above the midpoint here. Looking at our momentum across the board, we continue to be negative. On the daily charts, all of these continue to be positive. So we're seeing a little bit of mixed signals here. The Chaikin money flow, looking a little better on the daily chart. It's also showing a bit of improvement here on the weekly chart. It's still negative, but we're starting to turn up with the moving average, and we're getting closer up to that zero level. The Chaikin oscillator, longer term, we're crossing back after we had an extreme negative reading, and this is still negative, but showing some improvement. The force index is above zero. That's positive. And we're still below 50 with the money flow indicator, but we are showing some improvement there. The rate of change going back 1 week, that really dropped off after we had the monster week a week ago. Going back 50 weeks, we are pretty much flat right now with this indicator. The RSI based on 14 weeks, we're above 50 and advancing. That's positive. The weekly special K chart is still below the red line, which is a moving average, and we're also negative on the daily chart. The stochastic RSI is above the midpoint and advancing. That's turning more positive. And the Williams percent R is also above 50 and advancing. That's more positive. The ultimate oscillator, which gave us a very rare extreme positive reading on the daily chart. We don't get very many of those. You can see a lot more of them here. But it's also looking a little bit more positive on the weekly chart because we're crossing above the midpoint. The vortex has actually turned positive on the daily charts. We're still negative here on the weekly charts. The Copic curve rolling over but has not crossed over yet, where we're seeing it more positive on the daily charts. Looking at our longer-term fib levels and longer-term resistance, we're still hanging in there. We're above all these moving averages. Our different charts, the Heikin Ashi is turning back more positive on the weekly chart. We're turning back positive, or it's turning black on the Kegi. We're still negative, though, with the Renko, and we're turning more positive with the 3-line break. The ease of movement, and I look at the 14 weeks, we're positive on the daily chart, but we're still coming back up and have not crossed above zero on the 14-week chart. And we did show a new X drawn on the daily point and figure chart, but there's nothing new here. We're still working off of the low pole reversal that was generated on October 30th. That's positive. And we're still maintaining things in a more positive posture here. Looking at the Elder's Impulse system for the second week now, we are positive with green bars. And this is a big one. We have now switched back to the parabolic SAR with a dot underneath. It had been negative going in from the latter part of July throughout August. This is the first time that we're seeing a dot underneath. That is longer term positive. And I rank this as a pretty big indicator. I don't rely on it completely, but it's up there near the top of the list. Looking at our PPO studies, we're starting to turn back up a little bit with the long term. We're still negative, but showing improvement in the intermediate term, where we're positive in the short term. And then I have some daily charts. Here's the daily parabolic SAR, where it's positive. So now we're seeing some confirmation. The daily chart and the weekly chart are confirming each other, and they're looking more positive. Here is the trend line that I've been talking about. This goes from the October 2022 lows. It connects to the March 2023 low and then just extends out, where this was significant overhead resistance. You notice we were making higher highs here, but we were not able to close above that. We weren't even able to get above this trend line. Well, in Friday's session, we were able to get above that, and we were also able to close above this other trend line here. So for right now, if we can hold on to this, this is turning things more positive. The Dow. The reason I wanted to show this is we're above the 50 and 200-day moving averages on the daily chart, and we're getting ready for a death cross here. But if we can stay above this, we might be able to avoid that, or at least make it very short-lived. The NASDAQ 100, this was another area where we came back to this previous all-time high, and that was acting as overhead resistance. Well, in Friday's session, we were able to close above that. So this is looking more positive as well. The NASDAQ also looking a lot more positive, above this R1 level and closing at the high, and kind of looking like it's breaking out a little bit. And then keeping an eye on the fib levels for the NASDAQ, we're above the 50% retracement level. Now we're coming up to the 61.8% retracement level, wondering if this is going to provide resistance. Then the small caps, this is where we're seeing some weakness, where we had that monster day a week ago and then spent pretty much the rest of the week giving it back, only to see a bit of a bounce on Friday. The mid caps also monster gap higher, give back, bounce on Friday. The FANG index is still hanging in there, not setting an all-time high yet, but we're breaking out above the 50-day moving average and longer-term positive. And you'll have to excuse my voice. I did about 7 hours of lecturing before recording this video, and so my voice is pretty tired right now. The FANG index longer term, I had drawn a trend line here between these two highs. Well, we were able to break out above that and close above it, so that's more positive. And then a weekly chart with our arithmetic scale, we're up above this trend line going back to 2009. Then looking at some broader areas for seasonality, November tends to be one of the more positive months. According to the Stock Traders Almanac, it's the best month of the year. Right now, we're up 4.8%, and we're up 80% of the time. Then looking at the S&P, the mid caps and the small caps, we're still seeing some weakness here with the mid caps and the small caps. They bounced up on Friday, but they're in a more pronounced downtrend. The Dow showed a bit of an improvement. We're above both moving averages. We need this to go back up to turn more positive. The NASDAQ is looking more positive, above both moving averages. The NASDAQ 100 also coming back and showing some strength. The mid caps, though, we're working off of a recent death cross on the weekly chart. We're also seeing a death cross on the daily charts. We're going to need to see a lot of improvement here. Now, as a bit of a sideline, I've been watching mid-cap growth to value very closely, and growth is still hanging in there for the mid-caps. It's not doing as great for the small caps, and this could be under the surface, longer term, more positive. The small caps are also in a downtrend on the weekly chart here. The NYSE also coming to a death cross here and looking more negative. We need to get back above this to turn things more positive. All stocks, after really dropping off, have been able to come back up, and they're above both moving averages. The blue line's still on top, even though it was rolling over, but we're seeing if this will lead to some improvement. The 30 biggest software companies, this is a death cross that we've seen, but it had a good week this past week. Wondering if that's going to show some improvement. The FANG index on a weekly chart is looking more positive here. This is what I was talking about with the previous all-time high. We haven't been able to break that yet, but we closed just at 8,000 with the FANG index. Looking at ARC, well, it's kind of in between a death cross and a golden cross right now, where it was down on the week. Looking at the banks, still under a lot of pressure here. We're right about at 50 with the RSI. The overall bar chart is not looking all that healthy, and we're starting to drop negative with the MACD. Looking at the deposits for all commercial banks, you can see the number here. There were outflows from the previous week, but overall, we have been seeing this line going up, meaning that people are putting more money into banks. Then looking at just a blanket chart of Dow theory, traditional Dow theory just uses the Dow and the transports. I also include utilities. The transports are just not performing all that well right now, where the Dow is holding up a bit better. Also, when we compare the transports to the S&P, it's really underperforming right now, and that is negative and a warning sign. Utilities have been really weak as interest rates were going up. Well, as interest rates have been coming down, we're seeing a bit of a recovery here with utilities. Some other indexes, the CRB index really dropped off this week, but it's still in an uptrend. Oil dropped down below 80. We closed at 77.17. Copper continues to be in a downtrend. The dollar was actually up on the week and is still in an uptrend, both on the daily chart as well as the weekly chart, and this could be pressuring stocks. When we look at gold, it was really starting to break to the upside, But as things appear to be calming down a little bit, gold has been coming back down, even though it's just barely in an uptrend right now. Silver also kind of tried to break out, but didn't do as much as gold did. It's also showing a recent death cross here. Looking at bonds, where the total bond ETF continues to show weakness, we have a recent death cross. The stock to bond ratio shows stocks outperforming bonds. And then we're looking at the 1 month yield, and we subtract the 3 month yield. We're getting an answer of 0, which is kind of crazy. Usually we should always get a negative answer here, because a 1 month yield should pay less than a 3 month yield, because that's longer term. Looking at the yields where we were really going up, and now we've been seeing interest rates starting to come back down. Here's a weekly chart showing that the US still has the highest rates, followed by the UK, and then German rates, and then the red line are Japanese rates. Some relative studies, we look at intermarket analysis. We're going back to the beginning of 2023. Stocks are in the lead, followed by the dollar, and then gold, and now oil, which was screaming really well. It's now just barely positive going back to the beginning of the year, where bonds continue to be negative when you look at them based on price. Going back to the beginning of 2022, we still have oil in the lead, followed by the dollar, gold, and stocks and bonds are still negative. The NASDAQ to S&P 500 ratio, the NASDAQ 100 is really outperforming, and that's more healthy for the market, and that's what we've been seeing in 2023. The S&P 100 continues to really outperform the S&P 500, even though both did good on Friday. Growth to value, we're seeing growth make a little bit of a comeback here when we look at this ratio, and that's better for buy low, sell high. And the gold to S&P ratio, well, gold has been under pressure. The S&P has been going up, so we saw this ratio really go down. And gold to the dollar's been hanging in there. Gold is starting to give something back, so gold is back to now underperforming the dollar. Bonds continue to underperform stocks on a shorter term chart. The low volatility stocks were coming back down to this area here where we did set a bottom before. We bounced up off of that. Is that going to happen, or is this ratio going to continue to fall? Discretionary continues to outperform staples. Discretionary is more growth oriented, or staples are more value oriented, more defensive. The energy to tech ratio. Energy really went down as tech was going up. So energy really is continuing to underperform tech on this ratio. Our long-term trend studies, this is the NYSE breadth thrust, where we set a buy signal back in October 2022. So that's over a year ago now. And this is still on the books for right now, looking forward. This is interesting. We've never seen anything like this before. We had another signal this past week given to us by the ZWAG NYSE breadth thrust. Just to see one of these is very rare, but to see two of them within the same year is even more rare. When it gets extreme negative and then shoots up out of that, that's a buy signal. And this was developed by Marty ZWAG. That was one of the very first books I ever read, was written by him. He's since passed away. Well, we had one in March that was generated, and then wouldn't you know, right near the end of October going into November, we saw another one of these being signaled. And these are very positive, and they tend to stay on the books pretty much indefinitely. The Zohorchak method, though, it hasn't gone back to looking positive yet. We had a full-on buy signal here, and then we dropped off as the market was showing some weakness. Longer term, going back to the 1987 crash, we're still underneath this long-term trend line. And then taking a look at that same chart, but shorter version of it from 2018, we're wondering, are we going to be able to get back up to this trend line, and will that end up acting as resistance? And then here's the NASDAQ 100 weekly chart. We're a little bit closer here, but this is long-term, and this could provide some overhead resistance. We look at a ratio between the NASDAQ 100 and the Dow, and that's continuing to go back up slightly, but not back to this previous high. And this is interesting. We look at the QQQs, that's the NASDAQ 100, and we look at the IWM, which are small caps, and this ratio is really starting to go up. In fact, it's starting to break out. Another time when this happened was right during the dot-com boom and the dot-com bust. So we're watching this to see if this is going to turn around and start to come back down. That could be quite negative. As long as this keeps going up, that could be positive. Then we look at the cumulative new highs and new lows for the NASDAQ. For the last number of years, they've been really dropping off. We continue to be negative. This is just a raw score from one day to the next where we're below zero. So most stocks in the NASDAQ were down on Friday, even though the NASDAQ and NASDAQ 100 were up. We're also keeping an eye on this. We don't know if this is still relevant, but we still want to watch this. This is the 3-month yield. When we hit this level and then started to come down in 2007, that led us into the great financial crisis. We're wondering, are we going to begin to roll over here, or are we going to start going up? And if that happens, is that going to give us some kind of a warning sign? Then looking at Tom Bowley's research, where we're coming more into the positive time, at least for the first couple of days here, and then we're going to be entering some negative time as we go throughout the week. Then looking at our outlook, and this is just for Monday, we are still dealing with earnings season. Even though we're beyond the bulk of earnings, there's still reports that will come out and can be influential. Keeping an eye on Israel, wondering if that's going to escalate. We're seeing a real spike in the equity put call ratio on the daily chart after Friday's session. That usually goes down on an update. It went up on an update, and that could be some hedging that took place ahead of the weekend. The technicals are positive, and we're above resistance. That's just on the daily charts. We will get the Treasury budget. That was supposed to come out on Friday, but for some reason they bumped it back to Monday. And then keeping an eye on all the different geopolitical events. There were some things that happened in Syria with the U.S. doing some bombing at Iranian-backed targets in Syria. Of course, we're watching what's happening in Israel. And then here's the economic calendar. This is going to be a big one. We're going to get CPI on Tuesday. We're going to get retail sales and PPI on Wednesday. I think this is big on Thursday for industrial production and capacity utilization. Also, I like Fridays because the report that's coming out, because this tends to be a leading indicator of what's happening economically. Looking at the Stock Traders Almanac for November 13th, we're positive with the Dow, neutral to positive with the S&P, and we're very positive with the NASDAQ. So we have, at least for Monday's session, some positive seasonality. Now I have a number of different charts to go through. On Monday, we will be on the 9th trading day of the month, where we do tend to see, that's the green dashed line, that's a pre-election year. Then when we look at this for the whole month, this is when the current president is running for re-election. We do tend to see positive seasonality. Here's another chart going back from 1990 to 2022, where we also tend to see more positive seasonality. I don't pay attention to the gray line because that's like, you can take out any numbers and have this say whatever you want. Here's another chart going back to 1950, also showing positive seasonality going into the end of the year. Then when we look at the Stock Traders Almanac for the NASDAQ, we do see some bumps along the way, a little bit of weakness later on in November, but then November ends up closing strong, and then we tend to see positive seasonality going into December. Now, it doesn't mean this is going to happen. It's just, this is historically what has happened. We follow the green line on this chart. Also, a little bit of weakness before we see some strength at the end of November. Then here's a chart that I got from Isabel Net, put out by Carson, where Monday, Thursday, and Friday tend to be more positive in 2023. The markets are more positive on Mondays and Fridays. I think there used to be a book said never buy on Monday or something like that. Well, this kind of negates that, at least for this year. So our scenarios that we're going with right now, we're not going with the down scenario on the daily charts because we're just looking pretty positive. We are leaning more positive with things. We're not going sideways. Even though the ADX is weakening, it's still above 20, so that suggests that we're in a trending environment. The warning signs, the daily chart and the weekly chart for the daily special K are, or I should just say special K, are negative. The longer-term equity put call ratio is still going up. Please be aware, when I went to make the daily video today, some of this data had not been updated yet. And the 5-period equity put call ratio is also going up, and we're starting to get extreme with that reading. But watch Tuesday's video to get more of an update of that. The risk on posture that we're showing right now is still weak, even though it bounced up a bit on Friday. Our longer-term new highs, new lows study is negative, but it's starting to tick back up, but it's still well below zero. The Russell, the small caps, and the mid caps continue to be negative with recent death crosses. The financial sector is right on top of its 50 and 200-day moving average. If it can stay above that, that would be more positive. If it drops below it, that would be more negative. The longer-term signals that we're seeing, these are the weekly charts for the S&P and the NASDAQ 100. We're still below that longer-term trend line. And so we just have to say, is that signaling a top? The cumulative new highs and lows for the NASDAQ continue to show multi-year weakness. The 3-month yield is above where we were back in 2007 and maybe starting to roll over, where here it's still rising. The earnings season can either be positive or negative on a day in and day out basis. We had Apple report a week ago. It was down and the market went up. Go figure. Then the positive signs that are longer term, I'm sorry, these are just for Monday's session. Our oscillators for the S&P and the NASDAQ are all positive. The parabolic SAR and the vortex indicator are positive. The bullish percent index is positive and advancing, although it's still under 50. Small and mid-cap growth is positive, with mid-cap growth even looking a little bit better. Small cap growth is pretty much chopping sideways. Then longer term, we did have another ZWAG NYSE breadth thrust. That's a very rare event. Seasonally and historically, November tends to be the best month of the year. Longer term positive seasonality and setups that are well under the surface are still there. And then the S&P is still above the downtrend channel upper line. I started to show that chart when we were really going down, but now since we've gone back up, I don't show that chart right now. So our conclusion, just for Monday's session, we're positive and above resistance. Can that continue? Can we deal with some positive seasonality? Is that going to help the market? In the short term, we're above resistance, but we're seeing some overbought or extreme positive indications. We're slightly overbought in the intermediate term, but we're also above resistance. In the long term, we're positive because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. Please feel free to check out the daily video. I'll also be posting the intermarket analysis video as well as the deep dive video. I hope you have a wonderful weekend, and I will talk to you in the next video.